Good afternoon and welcome to our international webinar on Luxembourg as a European hub for Polish VCs. It is a real pleasure for the LPA to co-host it with our partners of today, Barbara from PSIC, with the Polish Private Equity and Venture Capital Association, and Arthur from LPCC, the Luxembourg-Poland Chamber of Commerce. For those who do not know us yet, we are the Luxembourg Private Equity and Venture Capital Association, so the cousins of PSIC, and we represent, promote and defend the interests of our community and certainly also of our industry. Like PSIC, we are both members of Invest Europe at European level, and we also have digitalized a lot during last year. So if you want to have a look at our website or YouTube channel, you will see all our recent activities. Today's webinar will be split in two parts. The first one will be hosted by our active member, Anja Grenner from TMF, and she will give you an overview of the Luxembourg ecosystem. The second part will be the panel discussion with different experts from Luxembourg and Poland, and they will share their own experiences in Luxembourg with their structures and VC funds. As usual, the webinar will be recorded and you can actively participate via the chat function or the Q&A button. So don't hesitate, we are here to help out, and we'll probably also have a few Q&A moments at the end. So without further ado, I will pass over now the mic to Arthur from LPCC.
Thank you very much, Stefan. Thank you and your team, the Luxembourg Private Equity Association, as well as Barbara and the team of PSIC. And we are very happy and proud to be your partner. We are a little bit broader on the market because you are very specialized on your products. We are at the Chamber of Commerce and we do, our main work is to bridge both countries, which is Luxembourg and Poland. And we do events in both countries, and we do them in Luxembourg as well as the Luxembourg Embassy in Warsaw. Our events are only business events, but in many sectors. This time it's about VC, next time will be about logistics, another time will be about ICT, and so on and so on. If we go to the next website, you will see that we have already over 60 corporate members from all the sectors which are interesting in the interest of both countries, of Poland and Luxembourg. And when we go to the next website or slides, you see that we are fully business orientated. We are a diverse team. And what is the most important, we are a non-profit organization. We do it because it's our passion to bring those two important economies together. And finally, we are the first Chamber of Commerce in Luxembourg who got the recognition from the Luxembourg Chamber of Commerce, which was the accreditation process, and that happened this year at the beginning of 2021. So if you want to join us, please contact us anytime. My name is Arthur. I am the chairman of the organization. We have been existing on the market in both countries in the last 9 years. And we have a lot of projects in the future. Therefore, just go to the website or just contact us via email. Thank you very much. And I pass the word to Barbara.
Thank you very much, Arthur, for a nice introduction. I would like to welcome everybody in the name of PSIC, the Polish Private Equity Association. I would like to thank LPA and LPCC, both Stefan and Arthur, for organizing this seminar, which is of great interest to our members and much in demand. Not to use too much of your time, I just wanted to say that we are an organization of 45 fund managers and 80 associate members who are active in the Polish market. And obviously everybody who is interested either in working in this market or joining this market is most welcome at PSIC. Without further ado, I would like to pass the floor to Stefan to start the seminar. Thank you very much.
Also from my side, thank you very much for joining this session. We are going to introduce a little bit sort of the Luxembourg landscape first. The type of structures which we have, the way we do business here, and then after that, about 10 to 15 minutes introduction. We'll have more of a panel discussion, putting a little bit or shedding a little bit more light on certain aspects which are important in structuring funds in Luxembourg for the purpose of investing in Poland. And we also have one GP who is going to give you a little bit more sort of personal experience on how it is as an asset manager in Poland when setting up the fund, because we here in Luxembourg will obviously sort of give you more of the theoretical background, but doing it in Luxembourg for funds and having the own experience obviously sort of is two different things. So we'll start with a couple of background information. I know it's number crunching, but I think some of the data is quite interesting. Here in Luxembourg for the fund industry, the people working in this industry is about 48,000. Now that's doesn't sound a whole lot, but Luxembourg, the entire country, has a little bit more than 1 million in total, and which means that you can see that there's a lot of people in this industry. So, and you can see the importance of this industry also to Luxembourg, and this is why the fund industry is probably the industry of the biggest sort of impact here in Luxembourg. You can see this also by a GP contribution of the fund industry with 13% of the GDP, which is far beyond what you would see in any country in Europe, and probably also in other countries as well. And it does reflect in the way we do business, and I'll come back to this one. Very important, here we are talking about private equity, obviously. Important, I think, in that respect is just to note that Luxembourg has always been one of the major players in investment funds. You can see that by the number of, or the percentage of authorization agreements for distributions to funds, and Luxembourg, for all funds that are distributed in more than 1 or 2 countries, 85% are actually sitting in Luxembourg. And with this legacy, this is also on which, to a certain extent, Luxembourg is building or built its successful alternative funds. Now, the number of countries Luxembourg funds are distributed to, this is more usage, but it shows what a standing Luxembourg funds worldwide actually have. And Luxembourg funds are distributed not only here in Europe or the United States or anywhere, but they are really sort of distributed sort of worldwide. Now, a little bit more coming to the alternative funds. And here you can see the importance of, in particular, alternative funds nowadays. With the advent of the AIFMD in 2013, when it was translated into Luxembourg law in 2013, we today have 266 AIFMs, which is quite a lot. Obviously, not all of them are funds that would be AIFMs that are used for third-party fund administration. A good number of those ones are in-house AIFMs that only manage funds of the same group. But in total, I would say probably at least 30–40% are probably AIFMs that do distribute and manage funds from third-party asset managers. Then we have one number, which is the number of registered AIFMs. These are small-scale AIFMs, which basically means general partners here in Luxembourg that are able to distribute and manage funds under the threshold. So smaller ones, basically, limited scale AIFMs. The number of RIFs at the end of December, that was the figure that I had until yesterday, was 600, but I'll show you a couple of more to show also sort of where we were at the end of December 20, and that'll come in a moment. And going back to where all these 48,000 people are working, just to give you a little bit of a flavor, the number of administrators here in Luxembourg is 140. So I would say every kind of asset managers is going to find an administrator here in Luxembourg, and the same actually applies to depositaries with about 60 depositaries. All the data is of end of 20, so December 31st of 2020. See, now here, and we are now coming and concentrating obviously only on alternative funds. You can actually see here in that slide the different AIFs, so alternative investment funds, which we have. And you can see that the strongest growth has actually been over the last years in this blue box here, which you can see. And those ones are, I just need to sort of see if I can get everything away here, because if not, I can see what is. The SLP is I would say probably the fund structure that has met most success, in particular with regards to private equity. Now, the SLP is the abbreviation for special limited partnership, and is a legal form which was introduced fairly recently still. So it was only it came into application in 2013 at the same time as the AIFM was introduced in Luxembourg. And here, obviously, the limited partnership is not a structure which is entirely new. Limited partnerships have been existing in the UK and in the US in particular. And this type of structure was missing in Luxembourg. We did have something similar, but it was not the same. And the SLP, which is an entity without any legal personality, met tremendous success. And it also helped in attracting a lot of capital, in particular from UK and US asset managers. And you can see sort of how quickly these actually expanded. It is entirely unregulated. We'll come a little bit later to this, but it's in particular the lack of regulation, which means positively turned around. The fact that it's got a huge flexibility really sort of made the difference. The other one, which is a success story, also, it's still even more recent. I'm just going basically down the diagrams, is the RIFE, the Reserved Alternative Investment Fund, which was introduced in 2016 only. And one of the reasons really was that we needed in Luxembourg at that moment a fund structure which was not directly regulated by the Luxembourg regulator. We had those ones before, and that is actually the CIF, which is the red one, which you see here, and the CCAR, which is a risk capital company. That's been existing in Luxembourg since 2004, and the CIF since 2007, but they were regulated, which meant also in turn that getting it approved by the regulator actually took a bit of time. The RIFE had similar features, and to a certain extent we'll come back to this. So it has similar features as the CIF and the CCAR, with all its advantages, but it's not, or it does not need to be approved by the regulator. So it can be set up anytime without having to wait for the approval from the Luxembourg regulators. And in that respect, it met a lot of success. The CIF and the CCAR also have an interesting tax regime, which differs from the SCSP or the SLP, as the SLP is a tax transparent entity, which basically means it ignores Luxembourg, the fund, for tax purposes, so that all, and I think Olivier is probably going to come back on this one. So basically all revenue is taxed in the hands of the investor. And the CIF, CCAR and RIFE have other solutions where there is a minimum tax for the RIFE and the CIF on the level of the fund, and the CCAR is a bit of a special animal, usually used for private equity and venture capital, where risk capital is tax exempted. So much to the, I would say, theory of the different funds we have. So you can see that the SIF is fairly stable. The CCAR is also fairly stable. And as soon as we had the RIFE and the SLP, these are the ones that today sort of gain more and more ground. And also the funds that I know from Polish asset managers either take the form of a RIFE nowadays or of a special limited partnership. And here's sort of a bit of similar data, just more recent than the one that I had on the first slide. On the upper one here, it actually says SCSP. Now the SCSP and the SLP is exactly the same. It's just that the SLP is the English terminology and SCSP is the French terminology. Here you can see as the SLP, let's keep with the English one, introduced in 2013, sort of developed fairly quickly. You can see here on the one side the overall launches, then the one in orange, which are the ones that are active for the moment. And the lower one, and that does exist, are the ones that have in between 2013 and today been liquidated already. So you can see sort of that for the moment, roughly the number of SLPs which we have in Luxembourg is about 4,500. It's probably a bit more because those figures date back to December 2020, so we might be a little bit higher. The second, the lower one, is a similar one, which is the RIFE. And there you can also see, even though it was introduced a little bit later, only in 16, we are already at a number of 1,250, which is also quite considerable. Now, the reasons why it hasn't touched, for example, the same number as for the SCSPs or the SLPs, is also the fact that the RIFE has one feature which is very important, which is shares with the old traditional good old SIFs and the CCAR, which is the fact that it has sub-funds. So you can pretty much introduce every year a new fund as a sub-fund. And here you only see the number of total funds, but not the number of all the sub-funds together, which is likely to be far higher. Now the RIFE obviously is also used not only for private equity, but also for venture capital, real estate, infrastructure, and any other kind of alternative assets. So you would also have in this number other asset classes than just private equity. But these two are the ones that are most commonly used. Here, in a nutshell, once more, sort of what we have in Luxembourg. We always call this a toolbox, as it shows all the different structures. You can see on the top part the supervised ones. SIF, CCAR, I mentioned. I'm not going to go into details with the Part 2 funds. On the lower funds, you have the RIFE and the partnership, as we discussed it. And we obviously have the SOPARFI, the good old company that is used also for acquisitions in particular, and used very often in coordination or cooperation together with a fund in order to make it tax efficient. In particular for the partnership, obviously, because the partnership, the SLP, is tax transparent. So very often the SOPARFI and the partnership are used within the same structure. Just being conscious of the timing here, we are going to go on into more detail on the tax side, but as a very general sort of couple of points here, generically, the idea here in Luxembourg for investment funds have always been that the taxation should be done in a way that the investors in a fund should not pay more if they hold an investment through a fund than if they did hold it directly. So that's the principle here in Luxembourg, so there should not be any disadvantage of going in order to to invest in an asset, should be not disadvantaged vis-a-vis those ones that go straight. Then we have, and this has always been one of the assets obviously of Luxembourg, Luxembourg benefits of the high number of double tax treaties that it has with other countries. It has the lowest VAT in the EU, at least for the moment. Then we have on the taxation, the RIFE and the CIF, we have a general, we call this taxe d'abonnement or subscription tax of 1 basis point on the net asset values of the fund. In the CCAR, which I just mentioned, it's slightly different because risk capital is tax exempted. And one of the reasons why Luxembourg has always been so well perceived is the fact that we don't only have a large number of different legal structures, if you think back to the last slides, but we also have different regimes. So we have taxable entities, we have tax transparent entities, we have partnerships, common funds, companies, so any kind. So normally, wherever asset managers are coming from to set up their funds and wherever the investors are actually sitting, normally everybody is going to find his pleasure, or as you say in French, bonheur, with all the different structures that we have. One of the major issues that we also, or major the advantages that we have here is the fact, and that's really important, that management related services, and management related is obviously the management as such, which is reflected in the advisory fees or in the management fees, but also administration services are considered part of management related services, are VAT exempted. That originally only applied to UCITS funds, but it was then extended to CIFs, and then later also to RIFEs and also to SCSBs, as long as they are considered alternative investment funds. When we talk to clients that come here to Luxembourg asking them, what at the end made you come to Luxembourg? One of the major answers is always, it's the stable tax framework. So it may not be the best overall. I know that, for example, Jersey doesn't have any VAT, but overall, I think the majority of our clients in Luxembourg, and obviously their investors, are looking for stability and a predictable tax framework, which is not changing every time a new government, for example, is being elected. And then the important piece, but I mentioned that one already, is if you have limited partnership, for example, or mutual funds as tax transparent entities, we tend to combine them with taxable companies to take advantage of either the double tax treaty network or within the EU, the parent subsidiary directive that works obviously only within the EU. So this in a nutshell is the pros of the tax environment here in Luxembourg. This goes here, and I think this is very important, and I know that we are coming back on this one in a couple of times more. What I just wanted to show you here is, while it's tax related, obviously, but is the substance. And substance is something that not only in Luxembourg, also in other countries, is something that today is becoming more and more important. We have BEPS, we have the PPT today. Everything basically leads to requiring more substance in Luxembourg. So just having, like 20 years ago, a company for tax purposes and the fund in another jurisdiction, a board yet in another jurisdiction, the limited, the general partner sitting in a fourth country, is something that today is not necessarily working anymore. So basically what we see today is, if you want to also take advantage of certain tax tax benefits, then if you have a fund, you normally put both the fund and the SPVs, but also the general partner and the AIFM into Luxembourg. And that is something where the AIFMD has been moving into a similar direction as we've always had also for the UCITS funds. And obviously that is something that also the tax advisors are normally making sure that this is something that is being respected. And we'll cover that a little bit later in the tax section. So I'm not going too much into detail in this one here. And then very quickly, because we always obviously sort of get the question when you go to Luxembourg, what are the services that we would require when a fund is being set up? And the answer is, first of all, obviously, you'd be starting the discussions with your legal advisor in your home country, so normally in Poland, then a legal advisor in Luxembourg and a tax advisor for the reasons already just discussed. Then there's, in the majority of the cases, not always, but you would normally always need essential administrators, and then depending on certain aspects, an AFM and a depositary. So these three services are the ones that you would require always for a RIFE and for a SIF and a CCAR normally as well, with certain exceptions. For the SCSP, it depends, but here we are going already into details, but in principle, what you always need is a central administrator in Luxembourg. And then obviously you need directors in the general partner of the fund or the board of directors, whichever the case may be, depending on the legal form. And then we have as, and this is where the different coloring comes from for audit, CSSF and depositories. All these services are more of a oversight or controls function. So ultimately, even though certain funds like SCSPs don't necessarily have to be audited, ultimately, also essential administrator, for example, is subject to supervision by the CSSF and is being audited. So in a certain way, these will always sort of feed in together. And for example, if you are appointing an AIFM, you will also have to appoint a depositary. So to a certain extent, these go all hand in hand. On the left side, I covered a little bit, a couple of the services, the base services for central administrators, like domiciliation, COSEC work, accounting, the registered transfer agency sort of investor services. AIFM, I'm not going to cover because Sylwester is going to cover that a little bit later. And depository, as I said, is more of an oversight function, which I can also explain a little bit later if we still have a little bit more time at the end. So the nutshell version, why we, from a Luxembourg angle, think why you would be going to Luxembourg, and this is what usually sort of our clients tell us. First of all, it is the largest jurisdiction for cross-border funds worldwide, and it has its reputation. It's the political stability, and it's also the tax stability, which is important. We have more than 170 nationalities here, so there you will always find a lot of service providers here in Luxembourg that will have also Polish-speaking staff in any of the service providers. The first piece, the global fund distribution and the pan-European fund distribution, is probably sort of closest to the heart of the asset managers, because if you today want to distribute a fund worldwide or only to certain countries here in Europe, a Luxembourg fund is known to all investors. So you don't have to have any questions on why you're in Luxembourg. It is just the jurisdiction to use if you want to target investors or limited partners in pretty much all European countries and beyond. Then, as I mentioned sort of over the past slides, the legal toolbox with a variety of fund structures available, also tax structures available, the knowledge in how to structure funds. And here I'm obviously sort of relating also to the large network of international law firms and tax advisors, a regulatory framework which is fairly pragmatic. And the last one, and this is something not to be underestimated, a network here between the different service providers. So even if you haven't been too familiar with Luxembourg, you can be assured that still, even though it's got about 48,000 people sort of working in this industry, a lot of people know each other and have been working in cooperation with each other and help usually sort of also our clients sort of find their ways around. I'll leave this one out here. Sort of, it's more, let's say, the challenges that we are having in Luxembourg, because all here is not paradise either, obviously. But that is the moment also to introduce to you Sylwester, Janik.
Okay, thank you, Anja. Let me just briefly introduce Cogito, because I think it's quite necessary with respect to the context of our discussion today, which is why, at least with regards to Cogito, why we decided to set up a fund in Luxembourg. So Cogito is a VC firm based in Warsaw, Poland, US, New York, USA, and we invest in later stage technology companies operating across European Union, including Central Europe. So we invest in companies either originating in Central Europe or entering Central Europe from elsewhere, but the common denominator is that all these companies should have product or services with a global expansion potential, especially US market. And the other important issue is that more than 90% of our investors, our LPs in the fund, are international institutional investors. And that actually determined our decision on the structure of the fund. So Cogito Fund 1 is registered as SLP, actually it's SCSP RIFE. And we decided to go for RIFE specifically, as Anja mentioned before, due to this special flavor, being with a fast track for registrations. This structure enjoys a quite high level of regulations, but that means that for large institutional investors, it's very plain vanilla, I would say, structure. So we specifically decided to choose SLP RIFE because we knew that for majority of our future investors, such structure will be well known, well recognized, no questions. In the same time, the relatively high level of regulations, but also transparency, gives us a much more flexibility in discussions with future and potential investors. So that was the key reason why we decided to go for actually our RIFE structure in Luxembourg. So, and yes, the slide before was, and I was asked to present my view on advantages and disadvantages of having a fund in Luxembourg. So in terms of the key three advantages, they are really linked to what I said before, which is it's mature and stable system, legal system, tax system, quite a broad choice of fund structures for alternative investment funds. So whatever you investment strategy is I said, VC, private equity, or real estate, it's actually quite easy to find a suitable structure. And the other point, as I said, this favorable destination for international institutional investors. They know the legislation framework, they know this tax rules behind, and they are quite familiar with such regulated or unregulated structures of the alternative investment funds. We also, please remember that we registered our fund in 2019, so it was let's say, full deployment of Alternative Investment Fund Managers Directive. So that is why we decided to go for RIFE, and also that determined that we decided to go for external IFM. And in terms of, let's say, the third point, you can see here, well-developed sector of service providers. Being RIFE, we need to have depository, we need to have IFM, we need to have a couple of others, service providers, fund administration is a general, but also we decided to go for support of our IFM in terms of marketing, passporting, and valuation. And on top of that, audit, because it's, as Anja said, sometimes it's required, sometimes not, but in general, funds with large institutional investors, they go for external audit. And that's I would say there's three key advantages. These are disadvantages because it's not always so right. Having a fund in Luxembourg, it's relatively expensive comparing to, let's say, the SLP in Poland. But as I said, having such kind of investors, that was a no-brainer, to be honest, to register the fund elsewhere, because we just eliminated the whole section of the discussion and the presentation of the legal framework in Poland, which in fact for regulated funds it's quite similar to Luxembourg one, because Polish PFIs are very similar to IFM in their nature. But as I said, a Polish legal framework is less known to international financial investors. The other negative point is high level of personal rotation, and despite the fact that it's nearly 50,000 people working in the sector, we've been experiencing a high rotation of people, to be honest, across every department of our service, or of every kind of our service provider. So that's negative, because especially for our back office, for a CFO, a long-term working relationships with people on the other side of the table is very necessary. And if it's broken due to departure of many people, you need to build again working patterns, and which is sometimes difficult. And I would say that today is one of the most painful areas in terms of our experience. So that's in a nutshell the key drivers behind our decision. And I was always asked to tell a couple of words about what it takes to have the IFM in Luxembourg. So if we can move to the next slide, please. And so just to summarize, if you are RIFE, you need to have IFM probably, and usually every majority of funds go for the external IFM. For Polish listeners, IFM, as I said, in its nature, is very similar to Polish DFI, which is the entity responsible, regulated, authorized by the Securities Exchange Commission, whatever the name is in the specific country, that is permitted by the law to manage operations of the alternative investment fund. And we decided to go for external IFM, and usually the two basic areas of services the IFM provides the fund with is portfolio management and risk management. On top of that, you can also add AFM reporting, fund administration, or fund registration, passporting, especially within the directive. The funds raising capital from European investors needs to obtain the passports for every European market, and of course valuation. That's another area of the services provided by AFM. So we decided to go for a broad range of services, and we decided to go for one entity. Despite the huge number of those IFMs, not every IFM in Luxembourg provides the full spectrum of services. Usually it's a portfolio management, risk management, and I know funds that are using external fund administrators and depositories. With respect to our choice, we decided to have everything under one roof, and that was our decision. So in a nutshell, summing up, we are happy with we've been happy with our choice so far. That worked effectively for us with respect to the fundraising. We confirmed our assumption that having RIFE registered in Luxembourg would actually make much easier discussion on the legal structure, but in the same time it comes with a cost, so not every fund should go for that because it's a bit cost-heavy structure. So at least I would say the fund having at least 50-60 million euro of asset under management, I believe it's a minimum size to make this whole structure cost-effective, or actually to make the fund able to work within such a framework. So that would be my view. Thank you.
I would underwrite that as well. This is what I would also consider the absolute minimum of a size to make it worthwhile. I would even say that going forward, because I do not think that the flood of new regulation and compliance requirements, etc., is going to decrease over the next years. So it's well possible that the hurdle is going to move a little bit higher still also in the future. Sylwester, one thing I wanted to ask you, because you are seeing the two sides from an AFM point of view, but also as basically the advisor. We always get the question, if we now have an AFM, sort of, are they going to take the decisions? And how can they do the valuation of a venture capital company? How can an AFM sort of possibly do this? Sort of, how do you actually do this in practice? Who's doing the evaluation in practice and in theory?
Okay. So yeah, evaluation is always a tricky thing with respect, especially with respect to technology VC-backed companies. And in our case, we together, I mean, GP representing the partnership and the FM, we appointed external evaluator. So we have external company that actually provides evaluation reports every quarter of our portfolio companies. And that's a part of our internal valuation, a part of our of the EFM internal valuation. There is external evaluator due to specific nature of our early stage technology later stage technology companies, and in practice we have a third party evaluation provider. And in terms of the investment committee, AFM formally runs the investment committee, but again, the partnership and the FM, there is appointed the advisor who works for the partnership within the framework of the investment strategy and provides investment recommendation. But the final decision on the investment or divestment on the follow-on investments is done formally at the level of the investment committee of the AFM.
Maybe just one comment in addition. You could see in that slide that Sylwester had that the two main functions are obviously portfolio management and risk management. We have two types of funds here. There's the ones where the AFM is in Luxembourg is performing risk management and portfolio management, and the asset manager, so the client basically, so here Cogito would be acting as an advisor. And then another option is, and I wouldn't be able to put a number to the percentages, and the other option would be that the Luxembourg AFM would only perform the risk management services and delegate the portfolio management to basically back to the client. That works if the client is regulated in its own country. And then obviously also the valuation would be done logically by the portfolio manager, and Luxembourg would then only, the AFM would only perform the risk management. So both options are there, and it really depends to a largest extent on whether the asset manager is regulated in its own country. But there are also certain other considerations from time to time, and that is sort of how much substance do you actually want to put into Luxembourg? So do you want to also sort of put the portfolio management into Luxembourg? So that has nothing to do with being regulated or not regulated, but more a matter of substance. So the regulation point of view is one criteria, but it's not the only one. And we actually see both. It's sometimes there are countries where the majority of the asset managers are simply not regulated because it has always been this way. While in other jurisdictions, the UK, for example, the majority have always been regulated. So it's so there is not a one-size-fits-all solution. And so I would also say, sort of to conclude that part, sort of a thorough legal and tax advice and setup and discussions in the beginning is absolutely key to making sure that you find the right structure for your own fund. So there is no one single one that is similar to the next one.
Yeah, absolutely. As I said before, there is a broad range, and at the end of the day, the GP needs to decide which legal structure will be the most effective, having in mind the nature of the fund. You know, it's different discussion when you have a real estate fund or private equity or venture capital. Yes, usually VCs or private equity are not, portfolio managers are not regulated. So that is why, in our case, we decided to go for AFM also having this function. And maybe just also for Polish listeners, what does it mean in terms of actually portfolio management or risk management with respect to the investment committee? So AFM delivers risk memorandum or risk assessment report and portfolio report on every investment, every new investment, for instance. And with respect to portfolio management report, it's all about actually the investment target. In terms of risk memorandum, it's all about whether the proposed investment is in line with the fund investment strategy, the mandates of the key LPs, and so on and so on. So that's very, very important because especially when you work with large institutional investors, they would like to have this formally done, and all this required reports should be delivered before the investment committee. And also when you have investors that are quasi-private or quasi-public, it's sometimes even more important to have such a regulated entity being a fund manager. So that helps a lot, but also gives comfort to the GP and the advisor. And as I said, but the decision of the GP should be driven specifically by the nature of the fund, the investment strategy, type of LPs, and of course some requirements for alternative structures in the future. For instance, whether the fund would like to have a sub fund or not. Yeah, if you don't plan to have any sub fund, going for RIFE probably doesn't make any sense, and so on and so on. So yes, at least in our case, there was extensive discussion with our legal advisors.
Now we have covered sort of one aspect, which is the service provision and service providers and what you all need in Luxembourg and able to make this thing run. But I think now comes the part, this is probably sort of also obviously of essence and why we are doing the whole thing, which is how to invest. So we have the fund and we have all the service providers, and obviously Cogito, but also others are, when they are setting up the fund in Luxembourg, the objective is nevertheless to invest in Poland. What maybe Poland and maybe a couple of other ones sort of around, which sometimes I see also sort of if there are links between target companies in Poland and maybe sort of others in countries around. So, which brings us to the next point, sort of now where you have the fund in Luxembourg, how do you actually sort of structure the investments on one side? And the second one is obviously, since you are not the Red Cross, you do want to make money out of it, hopefully. So obviously, I know that Cogito also has a carry vehicle. So we are also talking about sort of how to bring the money back at the end, also sort of to you. And I think for this one, sort of for the structuring part, and there are obviously sort of investments in each country that are completely different from each other. I'm addressing the word to Olivier and Rafał, who can give you a little bit more explanation of how a typical structure would actually look like, the pitfalls, what to look out for, and how to do the investments. And so let me share the screen once more.
Thank you, Anja. So the way we've been organizing investment platform in the past is largely different than what we have to do today. So you may recall that there was somehow quite a use of empty companies, etc. in Luxembourg, or companies with low substance. Well, this is all over. And the reason for that, well, is if you recall, the Lux League has generated a lot of, let's say, trend. We can talk about BEPS 2.0, we can talk about BEPS, we can talk about OECD new initiatives, but at the end of the day, what is super relevant now when you set up a holding platform is substance for sure, but more importantly is function and purpose and beneficial ownership. And these are the trends. Having a company with substance today to make your investments probably not good enough. You need to show that this has a purpose. You need to show that it is the beneficial owner of it, the income it derives. You need to show something more than what you've been doing in the past. So substance is not the answer anymore, or is not the only answer anymore. So, and that has been ruled by ECJ court case. And those ECJ court cases, known as the Danish court case, now are super large source of inspiration for, let's say, local court. And you see a decision going in the same direction, popping up everywhere through Europe, like in Spain, Italy, Switzerland, Luxembourg. And so all those situations where you had empty companies, you can't rely on them today as if you hope to, let's say, get advantage of certain tax treaties or local exemption. So that would be number one. Number two, and coming back to something that was said before, there is a general trend in onshoring. So why would you see such an appetite for Luxembourg today? Of course, we can talk about stability of the environment, etc., which is the discourse we all know. But more importantly, you see that, let's say, large institutional LPs today don't want to invest offshore anymore. So if you go and hope to distribute or raise capital from, let's say, certain institutions, coming with an offshore fund is probably not the right answer anymore. In addition to that, with all those rules that I was mentioning before, the ECJ court case, the BEPS 2.0, etc., if they see from time to time, and there's been a recent, let's say, law in Portugal, if they see somewhere in the chain an offshore entity, you get prohibitive taxation. And if we want to talk specifically about Poland, we have seen in the recent past, or since a couple of years now, the tax authorities being super aggressive in fighting the use of empty shell or the low substance entities. So if you can go to the next slide, the answer we see today is, of course, and I'm going to talk specifically about private equity and venture capital, more particularly venture capital for this one, which is the same as private equity when it comes to structuring. We see indeed that, let's say, when you reach a certain size, you can opt for the RIF. And if you think about the SICAR regime, so the SICAR regime makes the RIF actually a taxable entity. A SICAR regime is basically something which fits private equity and venture capital without going in all detail. But you still need a platform to invest, because the fund and whatever is up the fund is your investor platform. And anything which is below the fund is your investment platform. You cannot hope that you can invest directly from the RIF into a target. Some exception in Poland might still be possible that you go from the RIF directly into a Polish target. We've seen that happening, and it's going to happen still maybe for quite some years. But the general trend is that a fund never qualifies for treaty relief, never qualifies for directive relief, and hardly qualifies for domestic exemptions. So you always need an investment platform. And that investment platform, if you have multiple investments, well, it's difficult to replicate the substance in any, let's say, SPV or in any company. So the trend today, the general trend, is to have a master holding entity where you will concentrate your substance and use the SPV with relevant purpose. For example, if you need a bank loan or if you need a management incentive plan, all those things can have, let's say, a relevance. So you give the purpose to your underlying SPV. And if you would see at target 1 here, we put a local SPV in the target jurisdiction. That happens. That takes a bank loan. So you have all your substance in the regional platform in Luxembourg. You set up an SPV, a local SPV, you take a bank loan and you go into the target. You can do the same with a Luxembourg SPV, which will have lower substance, lower function, etc., but still has a lot of purpose, because you will hardly see a bank making a loan to the platform. They want the pledge, and in most situations, they want the pledge on the underlying. So going through the platform is probably not an option. So giving SPV2 then quite a lot of purpose. And from time to time, you don't need that. So you go directly from target, from the master holding into the target, or from the RIFE into the target. And honestly speaking, the only instance where I've been seeing that is Poland. With such a structure, what would you expect is a neutral. You already pay tax in the target. You don't want to pay tax in the structure. So what you expect is to have a withholding tax-free repatriation up the chain, dividend and interest on number 1, therefore relying on treaty directive and local exemption. And more importantly, in particular in venture capital, avoid, let's say, what we call non-resident capital gain taxation. So you know that normally the treaty, the double tax treaty, give the right to tax a capital gain to the shareholder, but absent a treaty, or if the treaty benefits are denied because you don't have enough substance, enough purpose, or whatever, well, there are certain jurisdictions, and Poland is one of them, that may tax, let's say, the non-resident capital gain. So that may tax the capital gain in the local country. That's the worst that can happen in a venture capital environment. So summarizing this, the answer today is probably having a RIFE. Most of the situation under the under the tax regime of the CCAR, because that really fits the venture capital thing, with 2 advantages: that you have no subscription tax, you have no diversification need, and you don't need to use, let's say, fancy instrument to go from your platform into your fund. You know, a normal RIFE is not subject to tax. So when you want to exit from the Luxembourg entity to the normal RIFE, there is withholding tax on payment, and you need to use the so-called alphabet shares, etc. Well, if you go into a RIFE CCAR, you can pay straight dividend. There is no discussion. It's super neutral, super easy, and not much structuring around the exit. That probably closes, for now, what I wanted to say, and I'm happy to hand over to whomever to take the floor now.
Okay, Rafał, on your side, I mean, this was sort of the Luxembourg part of the tax structuring. How, as you are seeing that from the Polish point of view, let's assume that all the investments are obviously sort of in Poland, and the investors are sitting to a large majority probably also in Poland, but not only.
Yes.
How does that work in practice on the Polish side then?
Yes. Thank you, Anja, and thank you, Oliver, for that explanation, and also to Sylwester. So, as a market practitioner, I just wanted to briefly comment on what you said about the predictability and stability of the tax regime in Luxembourg. As a market practitioner in Poland, dealing with venture capital funds, both Polish and also Luxembourg funds investing in Poland, I would say that the Polish tax environment is completely opposite. It's not yet as stable and predictable and not clear as in Luxembourg. Although in the recent years, the legislators introduced several important changes incentivizing the development of venture capital investment in Poland. However, in my view, they still lack this stability and clarity. So when we look at Luxembourg SLPs, we have full tax transparency. And in Poland, unfortunately, the most commonly used vehicles and structures for venture capital funds, for small to medium-sized venture capital funds, are not tax transparent. In 2019, there were certain changes introduced that allow for certain tax sort of corporate income tax exemption for those alternative investment vehicles, regulated investment vehicles that hold 10% of shares in the portfolio companies for at least 2 consecutive and uninterrupted years. So there is certain exemption on one hand, but on the other, when you look at the kind of way venture capital investments are made in tech startups, it's rare that they can hold 10% for 2 years. So they actually are very often not allowed for that exemption. When you look at early stage investments, in 2 years, this shareholding, if not followed up, it's diluted. So then you get income tax on the level of fund, and then you obviously get income tax on the level, capital gains tax or income tax on the level of the LP. So this basically leads to double taxation. And not only it's about double taxation, but it also gives a lot of practical headaches to fund managers because they don't really know whether while investing they will maintain this 10% or not, whether they will be diluted or not. So they cannot really calculate properly their return on investment. They cannot make proper planning on that. This also impacts the carry for the team because either this part that will be taxed or not will constitute the base for carry or not. So it has a lot of practical implications in Poland. Obviously, as Sylwester correctly mentioned, the structures are fairly similar in Poland. However, this tax disadvantage kind of regime makes it a big difference for fund managers. And if I speak to our clients, what is their biggest kind of regret? Not being able to be structured and domiciled in Luxembourg because obviously of the high costs and the fund sizes in Poland. They say it's obviously the tax regimes, the lack of transparency and lack of stability. In Poland, unfortunately, we rely a lot on tax interpretations, which vary from kind of time to time, and this makes the system, the whole system, not predictable and not stable. So, from my perspective, my kind of market practitioner perspective, that is a huge difference why Luxembourg structures are obviously beneficial to the fund managers. Obviously, not mentioning the kind of legal surroundings that make it easier to distribute the fund and make the whole fundraising and describe those structures. Although, as Sylwester said, they are not that different when it comes to kind of legal structuring.
Do you want to add something?
A frequent demand that we have from, let's say, Polish management team is, well, can we reinvest the proceed, be it the management fee proceed, the carry proceed, the co-investment proceed, into the fund to cover our, let's say, GP commitment? Because, by the way, the idea here is to create a warehouse in Luxembourg where the money is, let's say, stocked, to say so, on a gross basis before it hits the pocket of the asset manager. Because when it hits the pocket in Poland, you tax at 19%, right? So the whole idea is something, a frequent demand. Is there a structure to reinvest on a gross basis versus a net basis? And with the Rafał SCA that I have depicted just earlier, this is something which is totally feasible. We can definitely move away, let's say, income from the Rafał SCA into a warehouse in Luxembourg, where we stock the cash on a tax neutral basis, giving the ability to the asset manager to reinvest on a gross basis versus a net basis. So the cost of money for them is, let's say, net of tax.
The majority of the funds that I have seen for Polish promoters had a separate carry vehicle as well. noting that not all funds always have a carry vehicle. Some do it via different classes of shares or tracking share classes, whichever the case may be. For Poland, in the majority of the cases, I have seen different carry vehicles. Is there a specific reason for this?
And carry return is carry structuring is of course important because that's the heart of the remuneration for the asset manager. And one thing to bear in mind is that, let's say, the use of a transparent vehicle is probably not going to fit the purpose, because what you want to avoid is create what we call dry taxation and dry tax, meaning you have to pay the tax before you get the cash. And again, coming back to that warehouse that I was mentioning, it definitely fits the purpose. So it's not only a reinvestment entity, but it's also an entity where you can have, let's say, which can serve as a blocker for the carry accrual. And only when you will distribute out of that warehouse the carry, you're going to be taxed as a Polish individual. So the distribution out of it is subject to 15% withholding tax out of that carry vehicle or warehouse, as you call it. And that withholding tax is subject to a credit in Poland. So the effective tax rate is still 19%. So there is no additional cost to that. But very importantly, avoiding, let's say, the use of transparent vehicle, you can do that for, let's say, a corporate governance point of view, but you always need to have an opaque vehicle somewhere, Luxembourg SRL, to make sure that you will not be taxed before you actually cash in your carry. You know, from the moment an investment performs, it can reach the carry threshold, and certain tax jurisdictions, including Poland, may say, well, look, you are already entitled to something, I'm going to tax you now, and you still don't have the cash. So you need to use the appropriate structuring.
From our perspective, carry vehicles in Poland, based on Polish structures, are not that common. Obviously, it is possible, and some funds have them. However, we have obviously less tax flexibility on that, and I mean, the most successful fund managers, so those who make successful exits, and they really start having tax issues in Poland, whether there's withholding tax or whether there is tax that needs to be paid before, as Olivia said, before they actually cash in, it becomes an issue. So we always, given that uncertainty, we always have to go kind of around and deploy structures that are not that easily manageable.
Okay, I'm just conscious also of the time. We have in theory not 15 more minutes for questions, and I think I'll leave the floor also now to our audience to ask specific questions. Please do note that Sylwester, because he had another appointment, is not in the call anymore. So any kind of personal experiences or won't work anymore. So we'll have to take those questions sort of differently and shoot them back to him sort of if that's needed. But obviously, Olivier, Rafał, and I are there to ask questions. Okay, so how do you we all together sort of envisage the further development of business between the two countries? Well,
I may have an answer there. We've been suffering, let's say, hard time. We've been suffering hard time with, let's say, COVID, etc., not being able to travel. And for me, the first thing to be done now is maybe to recreate some local connection, go and shake hands around Poland, and that's something which is definitely on my agenda for the upcoming months.
Now, obviously, quite a few of the the larger players here in Luxembourg, like obviously sort of all the big fours, some of the law firms, tax advisors, but also the administrators and also the banks, do have obviously offices as well in Poland. Obviously, so does EY. We do as well. There are quite a number also of administrators that actually have people and teams working in Poland as well. As Sylwester was rightly saying, Luxembourg is not the cheapest of all of the jurisdictions. So in order sort of to keep the costs sort of somehow under the lid, a lot of the Luxembourg administrators sort of also have teams sort of to support them. And that is something where I think that helps, obviously, because on the one side, it makes it a little bit sort of less expensive. On the other side, these people are normally very skilled and are can be reached also sort of in local language, obviously. So I think there is a lot still to be done. I mean, the fact that there are also direct flights between Luxembourg and Poland definitely helps. I'm just thinking about Ireland or Jersey or Guernsey sort of compared to this. So yes, I think there is still a lot sort of where the two countries can help each other, both for the asset managers going to Luxembourg and then Luxembourg sort of providing the infrastructure.
Yeah, I'm nodding because, you know, Polish venture capital market keeps on developing very rapidly, I would say. So I already kind of notice a bigger demand for Luxembourg structures and Polish fund managers. Obviously, as we discussed, there is certain threshold of assets under management that makes or doesn't make sense to move to Luxembourg. But those fund managers in Poland who are slowly becoming successful, meaning that they do successful exits and they start having, especially as mentioned, those tax concerns related to the lack of transparency, etc. Start thinking that for the next fund, the difference between actually the tax difference would allow them to establish the structure and maintain the structure in Luxembourg. So they're shifting their kind of mindset from downside protection to upside kind of protection, and thinking that maybe it is, even though maybe their management fee is not as high as private equity funds who are much bigger and have bigger assets under management, perhaps it's still worthy to establish and consider Luxembourg structure. So I'm very positive we'll see more of that in the next few years.
I think also like Poland, and that's something that I see more. Poland is also to a certain extent the entry gate into the Eastern European market. It's not just Poland, and a lot of expertise is actually sitting in Poland that also know the markets around very well. In that respect, I think it is interesting. On the other side, Luxembourg can obviously sort of expand through the large networks, obviously, of investors that are able and prepared to invest in Luxembourg structures. So having access to Polish investors is normally sort of the solution, in particular for the first funds. But as soon as there is a certain track record, then approaching a more international investor base, that is something that at least Luxembourg can, to a certain extent, obviously facilitate. We've heard that there is a problem at the moment with establishing normal operational banking relationship in Luxembourg for small funds. Can you comment? Yes, there is not only a problem with small funds, there is a problem with any kind of funds everywhere. And it's not only sort of Luxembourg. It is nowadays, also because of the regulatory environment, not easy to open accounts. That has nothing to do in particular with Luxembourg. AML, KYC aspects, compliance aspects sort of do not make it easy to open bank accounts. And obviously the fact that a lot of administrators sort of also have own depositories that are not banks means that there is a need to have a separate bank account with the banking institution while the depository remains with the, let's say, depository or administrator as an AIFM approved depository. So yes, it is definitely an issue. Also in that you have to take this into account when you do the planning, for example, for setting up a new fund. To open a bank account in a week is impossible. And a large amount of the time actually goes into the due diligence also that the bank has to perform. Now, there are still strong established relations also between some of the banks here and also companies in Poland. There are also new banks that appear here in Europe that work differently, sort of more online related bank. So in the majority of the cases, I mean, it's not that the banks don't want the business, but also their hands are bound to a certain extent. Their due diligence takes a long time. So it's obviously an issue, but normally it is a surmountable issue. I cannot recall, with the exception of a couple of extremely exotic funds or exotic investors, that we were not able to open a bank account. So it may not sort of work with the first bank right away, but normally if you know the banking landscape well here in Luxembourg and know which bank accepts which kind of funds or types of investors, then you usually find a solution. But I'm not denying that it's not a challenge. It is not that easy, yes.
Thanks a lot, Anja, for this efficient moderation, and also thanks to Rafał, Sylwester, and Olivier for this great panel, for sharing their practical insights. Certainly also huge thanks to Barbara and Arthur for being our partners of today. And concerning the bank accounts problem, this is certainly of high importance also for our association. That's also why we have an active depository technical committee who is working on that. And we also try here to partner up with different other associations and stakeholders in order to find an interesting and constructive solution in the future. Thanks a lot for joining, and see you soon again.